Hello?
Yeah, Peter, we're waiting for the countdown. Here it goes. Hi, everyone. This is Dale Pinkert. We have a special guest with us at a very important part of the market's juncture here. I've interviewed Peter Campbell several times over the last years. I find his analysis very insightful. I could use the adjective elite, and I'm not going to have to talk about it because you're going to hear it in a minute. Welcome to TradeGate Hub, Peter. What a great time to have you.
Yeah, great to be here.
And, I just, before we get to the markets, and I know you have some slides to share with us, that PowerPoint, but why don't you tell us how you got into the industry and your journey to MCM_CT.
Okay, 1 second. I just have to do something real quick here. Hitting a button. Okay, basically, I have been involved in Wall Street since 1993.
Okay.
And it's been an interesting journey because I've gone through pretty much every crisis that's happened the last 20 odd years, 30 odd years. And they seem to always follow an interesting pattern, and that's their relationship to the Federal Reserve. So,
okay.
So it's
interesting how you combine your knowledge of the Fed with your technicals and your charts. So, enough with the background. I feel it's so critical what's happening here this week in the market. And I'd like you to get to what you're seeing. And these are very compelling slides that you have. Yeah. And don't you think, Peter, that if this is the inflection point and the high in risk, that people are going to probably rationalize it and say the first 5-10%, that's just a normal correction. We were overdue for the correction. Yes. And that people will be buying dips all the way down because it's so ingrained in them right now because they've been rewarded doing this for so many years.
That's what it looks like to me. And I think that we're dealing with a change in regime, which is going to be very difficult for people to adapt to because they're not going to be able to get the exits that they're looking for easily. That's my impression. And I want to talk a little bit about why I believe that is the case. One of the reasons is because of the discussion that's on the screen right now. Basically, the reverse repo situation seems like it would be something that would be stimulative for the markets, and that's what it's advertised as. That's kind of how people think about it. But the problem is you have to understand that these are reserve assets that are being repoed, but they can no longer be used as fractional reserve assets. So they can be shown as reserve assets on a balance sheet, but they cannot be used to create new credit. And this is a serious problem for the market. So what this chart is sort of showing is that whenever we have increasing repo, what we end up having is decreasing credit creation or slowdown in credit creation.
Didn't they used to call reverse repos match sales? For that, wasn't that the open market operation that they would do to drain reserves? Is it
I think
a synonym?
I do remember that name.
Yeah. Okay. Well, I'm a dinosaur.
So basically what we're, showing in this chart, I don't know if you can see my mouse moving, but, that ever since we've done the reverse repo, we're seeing contraction in credit creation. And I think this is a really big problem. And this is, an article here, which goes into the discussion. And I think that is this is something I encourage everybody to read. which discusses more in depth as to some of the stuff that's going on with repos. But there's a huge misunderstanding of how all this works. And so the Federal Reserve is both tightening by doing repo, and they are trying to basically have the illusion that all of their credit programs are expanding and supportive and going to remain that way. What I think is important is to take a look at that. Since this repo operation has been going, you can see that it's had an effect on the Chinese credit impulse, which in this case, is I've shifted forward by 10 months, but the repo operation has been going on for quite some time, and it's about a 6 to 7 month lag, and it has now affected the Chinese credit impulse, and it's affecting the margin debt situation. So we're dealing with a serious issue here in terms of the credit underpinnings of the market, and it's
what exactly is the China credit impulse?
It's the demand for credit and the availability of credit, more or less, in China. And since China is the most speculative economy, and generally has the very speculative credit consumption, these are leading trends which tend to apply to the rest of the world.
Was this part of their strategy when they started putting a cap on commodity prices and actually selling things on physical markets to take prices down? Like copper being one of their main, they're the major consumer of copper.
Yeah, I think there's a lot of other things going on there. Yeah. In China. I think there's a lot of stuff going on. Their regulation.
Yeah.
I just have to tell him I can't. So basically, they're clamping down on businesses. They are restructuring education. They're closing ports. I believe right now, a lot of the things that China is doing are going to have significant impacts on the world because they're probably designed that way. So, for example, the port closures that they are doing are likely to create shortages all over the world of all sorts of things that we're used to not having shortages of.
Right.
And I think that this is a very serious problem. I think over the next weeks, we're going to start to see some unnatural shortages that are going to create serious issues and inconvenience to people. So it's probably a good idea to think about going to your Target or Walmart and picking up a few extra things. And basically, also, this is a chart here, which I lost one part of it that I wanted to show, but basically where we are in the S&P, we have a throwover up here, and I believe we're going to be dealing with a substantial credit issue globally, contraction, at the same time as that will be driving then asset prices to be more under pressure.
Are there going to be a financial crisis in the banks, Peter?
I think that, well, in the first slide, I talked about the high reserve regime, and it's important to understand what high reserve regime means. Basically, the banks don't have any money. They're all insolvent. I don't see any banks that I think are reasonably solvent. And the problem is that, I'm sorry, my computer is talking to me in the background. The problem is that the reserves that the banks have gotten have been given to them or lent to them more or less by the Federal Reserve. So all this QE and all these other things basically have been done in such a way that they actually are pumping money into the banks that they don't have. Then they show this money as reserves, lend it to the Fed or deposit it at the Fed, get paid interest, and this gives the bank this huge subsidy. The problem is that a high reserve regime creates a lot of long-term problems, and it's because it's not real high reserves. They're really the Fed's money. It's not the bank's money. And so that's why we're running into this repo problem, because the high reserve regime is kind of running that it just can't be done anymore.
Peter, is it a different issue that Wells Fargo withdrew credit lines to its customers? I think a few other banks have done that.
I don't think it's totally unrelated. The banks are not.
Because you're the first to say that it could be related. Everyone was saying it's just a technical thing and it doesn't mean anything.
No. I think we have high reserve does not equal credit creation in the way that people think it does. And I think banks are having difficulty because of this artificial environment that's been created for them. And then on top of that, people are less inclined to borrow. So I think this is all putting the whole market situation at a pretty extreme location. And if you see right now, this chart that I have on the screen, you can see that we have a very long-term channel, which goes with all of this extreme activity that's been going on.
Yeah.
So at the top of the very tippy top of the channel, let's see if I can go in there. Let's see, maybe I can do it a different way. Can you see?
It almost looks like a pitchfork, that channel. Yeah.
Let's see. You can see where we are right there.
Yeah, we can see. Yeah.
Right up. That was recently. And so to me, we're dealing with a pretty serious problem in the markets in terms of being extended. And we have on this monthly chart pretty significant divergence. I think this channel is really pretty and important. This is another tool that I have written versus the Dow Jones Industrial Average, which basically looks for parabolic tops and then looks for what it thinks may happen at those tops. And so basically how it identifies them is with this little red dot. And usually a parabolic top has two pieces. Has a red component, which is the first basically central bank crisis. This is automated, so it's looking at central banking policy and emotions. And then we have the rebound, which would be the second high. So that's the normal situation. If we look closely over here in the right, you can see this is what I have been expecting. And we can look closer at this. This is the Dow. This is the parabolic top that triggered, basically started in June. And the Dow has risen 1% in that time frame versus the S&P, which moved a lot more, and the NASDAQ, which moved even more than that. But this basically, if you look at it, was triggering around 34,700, 34,800, something like that. And basically the Dow got up to 35,500, I think, so far.
Yeah.
So this, what I would be anticipating in this, if we look at this correctly, is that we should get a sharp pullback here. I think I'm on the fence as to which one it is. Is it going to be something like this and then lower and then up? Or is it going to be just down to here and then making a new high? But what I think right now, what we're looking at is something much more serious. I think we're looking at hitting around the 3,000 area on the S&P 500. And then the Fed doing some new kind of intervention and getting the market to 5,000 or something like that. That's what I think happens, even though we're going into a really bad situation. This is, an interesting point here versus options expiration. So we have 1, 2, 3, bang, 1, 2, 3. So this is quad witch. This is options expiration, and then bang. So that's sort of where we are right now. Consumer confidence leads the stock market. So here we
had that bad number last Friday.
Yeah, and we would expect this to go lower, and also for the stock market to react to that, in my opinion. The dollar index looks to me to want to go quite a bit higher. And similar to what happened last year, and that is already happening. The Dow Jones put an interesting candle in recently. I think that for example, today we're bouncing a little bit off of our overnight lows, which I discussed yesterday was the target of basically 43.50. And I think we go back down starting this afternoon or the close. Just want to check the market here 1 second. And this is just an interesting chart here because it's showing the largest negative flows and participation that I've ever seen at an extended top in this sort of box. It's happening on multiple levels. Very, very negative.
Is this like AD stuff, breadth?
It's breadth related, but it's not exact. It's not like regular AD.
It's money flow?
It's not even money flow. It's sort of
okay. I give up.
It's a sort of proprietary set of
tools. It's a secret.
And basically you can see what has happened over here, at different times. At the same time, we have, VIX that tested this trend line and is in multiple
broke out
non-confirmation. So VIX over here is inverted, as you can see.
Yeah.
So markets should have, we should see both VIX rising and markets falling, I think, going forward. This is just sort of more standard breadth.
Yeah.
And we can see the same thing, non-confirmations, very serious ones here.
Where's that? Can you go back one slide? Where's that blue moving average line? I think that's what it is. That's for where's it coming in?
That's coming in, let's see.
3,000.
3,900.
Okay, a lot of targets there. Okay, go ahead.
Yeah. Globally, the global stocks versus GDP are like at an all-time high, 140% of global GDP. Just outrageous stuff going on here. In the middle of what is likely to be a tightening credit environment. And that is, one of the reasons that I showed the repo situation is because every time if we go back to the first page, here's VVIX also, and I'm going to go back to the first page there and discuss this. We have, a triple top blow off that's happened. So there's a lot of negative stuff, but the reason I want to go back to this repo situation is because essentially every time you see repos expanding, increased activity in repo, you see strengthening dollar every single time. What does that mean? that means credit. That means we're dealing with a credit
Contraction.
contraction, tightening credit environment.
Mhm. Okay. All right. So we have, do you think this week was it? I do. I'm getting 2-week reversals. I know it's not Friday yet, but to me, NASDAQ closing the 100 back under 14.9 was significant to me. And the S&P is right around that 43.75 is an important level for it to try and recapture. So,
Well, it's right now over that, but
yeah.
I think this is a very important area. I think the markets do reverse
Later.
and I think that we're the markets are in trouble for the next foreseeable months, and I think we could be dealing with a crash that's. I was thinking that it would be that the pullback would be more modest than what was going on in March last year, but I'm beginning to think that this can actually be worse in terms of number of points that we give back and in the time frame that we do it. So,
Okay.
you
Well,
know,
during the COVID crash,
percentage,
it was what, about 6 weeks, Peter? Straight
yeah,
down and what, 30%?
I think it was a little over 30%. And I
Okay.
think we probably could be dealing with a similar size percent contraction now, but it's a lot more points.
Yeah. Right. Okay. So really appreciate you coming and sharing your work. And if people want to follow you or get in touch with you, what's the best way for them to do so?
MCM_CT at Twitter is a good way to do it. MCM_CT. And also MCM_CT_markets, which is the proprietary market discussion that I do. That's for members.
Okay, well, fade Peter at your peril. Take it in, what he had to say. Look at the video again, and price is everything, Peter. So
yeah,
we'll see what happens.
I think people really need to take very seriously what's going on with this repo situation. It's not natural. It's a big problem, and we're seeing dollar rise and dollar strength because of it.
Okay. I mean, I actually think there could be a little bit of a dollar correction from this 93 to 94 level.
Oh yeah, of course. I think that those things can happen, but I think that
but you're looking for a huge dollar move. Give me a number where you think the Dixie can go to.
I think the Dixie can go to 120.
Okay. There's a dollar bull. So as Larry Kudlow would say, king dollar, king dollar.
Yeah.
And it's a wrecking ball for risk.
Yeah.
Thank you, Peter Campbell.
Okay.
Good hunting, buddy. Appreciate you edifying our community today at TradeGate Hub.
Great.
Okay, everyone, that's a wrap. You can find Peter Campbell at MCM_CT on Twitter. You want to follow him, get his research, send him a DM. And I hope everyone got something out of this and, realizes that markets can go down as well as up. So that's a wrap. That's a wrap. There is. And you know what, Peter, I was thinking while I'm wrapping this up, I was showing Apple for the past couple of days, and it's the largest market cap stock on the board, right? And it made a new high with divergence out of a wave 4 triangle, and it's reversing here. And Apple under 140 sayonara to the market. That's the way it looks to me.
Yeah.
So the Apple, right? Sir Isaac Newton discovered gravity when Apple fell from a tree. And maybe we're going to see gravity this way with Apple leading the way. So again, thanks a lot, Peter, my trading warrior brother.